Should you invest during a recession? Now, one of the most common things that we see during all recessions is a very high unemployment rate, right? There's other characteristics, you know, of course, we're going to talk about falling home prices, falling stock market. There's a lot of turmoil. People are scared. Fear is very high. Consumer sentiment's down. But I would argue that the most common thing that we see is going to be a very high unemployment rate, which really begs the question. Now, would you rather invest when the unemployment rate is low or whenever the unemployment rate is high?
Yeah, most people are going to say low, right? That's when consumer sentiment is high. The stock market's generally done well. As you said, housing prices, everybody's feeling really good.
Yeah.
But when unemployment is high, so if it's getting above 7%, no investors are feeling warm and fuzzy about putting their money to work. Nobody feels confident investing.
No, because I think it's human nature, right? Like human nature is saying, hey, like, this is a very stable environment. It's natural for us to say, I'm going to take on more risk whenever there's a more stable footing below us.
Yes, a very strong correlation there.
So corporate profits are rising. Profit margins are very wide. The labor market is very tight.
Yes.
And, these are all very good things. And so I guess the natural progression is it leads one to believe of, hey, if all of this is happening, therefore it's much safer and a much better time to invest in that environment.
Yeah, you feel good. You feel like the economy has momentum and great, this is a good time to put my money to work. The market's gone up 20% so far this year. Let's go.
Oh, yes. Yeah.
That's what most people are thinking.
Yes.
That's what most people are thinking.
Now, conversely, whenever the unemployment rate is very high, what does that environment look like?
It's really
not good.
It's really bad. Again, nobody feels confident. Consumer sentiment's low. Saving rates have gone down. Usually credit worthiness of the consumer has gotten worse. Housing prices are down and
bankruptcies are rising.
Layoffs are happening. Nobody's feeling like,
Fed chairman is on the news more often.
Exactly. You're seeing all these
CNBC
reports.
has the red banners, market warning or market alerts.
Yep. Nobody feels
Dow is
good.
down 4,000% in one day.
It's a confident one. Now, nobody feels better that way, but historically, that is by far the best time to put your money to work, right?
Yeah, I mean, obviously by the title of this video, you can guess what the answer is. And the answer is yes, it is a much better time to invest whenever the unemployment rate is high. And so what we wanted to do during this video is find out why that is. Why is that the case? So let's begin by showing this very big chart. So let me pull up this very big chart over here. Here we go. So what this shows is we try to answer this question by looking at the unemployment rate throughout history. And so we go all the way back to 1948. And so we wanted to identify periods where the unemployment rate is high and where the unemployment rate is low. So we categorize it as above 7% is high. And so it peaks 8 times above 7%.
Okay.
And it is bottomed out below 5% 8 times as well.
Okay.
And so in order to answer this question, when is a better time to invest? We took the next 5 years of the S&P 500 return, the 5 year after each one of these periods, to identify which is the better one. And so do you want to
so what happens on average, right? You take those peaks and you take the bottoms and you go, what happens on average? So when you look at the 5 year return, when unemployment rate hits those lowest points, so great part in the economy. It's just over 25%.
And it's not bad.
No.
25% is not bad at all.
That's great. That's awesome.
Yeah,
That's
I mean,
fantastic.
I'll take 25%, but that pales in comparison
yes,
to
that
whenever the
vastly
unemployment rate is
underperforms.
very high.
If unemployment hits that peak,
The
when
average
nobody's
return.
feeling good, the average return has been 72% over those next 5 years. So
Yes.
we have a massive difference here.
Yes.
And there's a whole number of reasons why, one of which is the stock market's generally a leading indicator, right? So when everything else is falling apart, unemployment is a lagging indicator. It's very slow to move.
Correct.
Like what we're seeing today, right now, where people aren't quite feeling happy about the economy. They're not really sure. We're seeing layoffs, but unemployment is still in a great spot. Stock market's already had a reaction this year already where there's been a lot of volatility.
Right. Yeah. So you got to understand that there is this disconnect between the stock market and labor. Again, like you said, the stock market is a leading indicator. It's not a leading indicator. It's a forward-looking indicator. So it's constantly trying to price in what the future is expected to hold. So anytime that there's any type of news breaking, that's why you see the stock market jump up or jump down based on whatever news that happens to be. And so 2022 has been a particularly not a great year for the stock market because it is pricing in the effects of higher inflation. And that's going to impact forward earnings and all this other bad stuff. However, whenever you look at, like you said, whenever you look at labor, the labor market is usually the last shoe to drop whenever they're in any type of economic cycle.
Yep.
And so we're starting to see a lot of softening in the economy right now. We're seeing corporate earnings start to fall, profit margins start to tighten up a little bit. And so the last thing that a company will do in order to try to shore up its balance sheet and its company is to lay off non-essential employees. And so we're beginning to see that in tech. And tech is a very sensitive industry whenever it comes to interest rate movements, because these are high growth companies, right? So their profit margins are not nearly as wide as some traditional companies. And so they rely on growth more.
Yep.
And so you're starting to see them lay off and cut their staff. But we don't think we're not anywhere. I think we're in the beginning stages. We may be in the second or third inning.
And most of the time, once this unemployment rate does peak, so once it is, say it goes above 7%, like in some of these 8 areas you showed, generally by that point, the market has already had a pretty big reaction. So that's why when you look at the next forward 5 years, you're generally buying assets at a much cheaper price already. Right. Now, that's generally the time where most investors don't want to invest. And it can be a time where if obviously somebody's losing a job or we're in a recession, there's a lot of things that can go on a personal level. But if you really look at the details of when's a better time to invest, it's not even close that it's a better time to invest.
Yeah.
Put your money to work if there is high unemployment rate.
Right. Because the market tends to swing in either direction too much. Whenever times are great and things look good, that's whenever bubbles are formed. Stock market has a very bad habit of going up too much to the upside. Likewise, whenever things are really bad. So whenever you're looking at household saving rates being very low and people are losing their jobs and you're watching the news and there's videos of people walking out of buildings with boxes of their stuff from the office. A lot of bad news is already baked into the share prices of these companies.
Yes.
And so a lot of that downside risk is already removed. And so all it takes is just a little bit of positive news for the stock market to come back up.
Yep. Absolutely.
And we saw that in pretty much every crisis, right? The latest one in 2020, the stock market bottomed out in March of 2020 or March 23rd of 2020.
23rd, okay.
And, arguably you can say that the news that actually helped, there's many different factors, but like the big positive news was Moderna coming out and saying, hey, like we have a really high efficacy rate of this vaccine that we're creating here of like 95%. And a few days later, the market just, bounced really, really hard.
Yeah.
And so that's just the nature of markets in general. It wasn't designed this way. It's just the way that human nature and the way these systems work together. And so as long as you understand how these work, then you can actually feel a little bit more confident about your long-term plan in your investment portfolio.
Yeah, there have been a number of surveys that track this. One we talk about all the time was done at the end of last year. And what it does is it looks at consumer sentiment and it asks basically thousands of investors,
my favorite stat.
What are their expected returns?
Yeah.
And last year, so December of last year, the survey hit its all-time high. So they ask investors, what do you think the next 10 years will hold? And so they ask, what's the average return you expect? And the average investor said 17.5% annual return. Real return. So that's after inflation. Yeah, so historically, if you take what it had been, let's say 2.5%, you'll say this person thought 20% per year returns for the next 10 years. And this survey, almost spot on, is a perfect correlation to if you just did the opposite, you would succeed. Because every time the lowest ever that survey ever showed up was 2009.
Yeah.
And it's just like any time. 2009 was a brutal time for the economy. Unemployment peaking, and people are thinking, this is the last thing I want to do. The market's going to go nowhere. It's going to be negative forever.
Yeah.
It's this recency bias where we feel like the people in last year were like, oh, 2020, 2021, investing's easy. The market's just going to go up 20% a year. No problem. And people in 2009 are thinking the opposite. It's going to go down 20% a year until it goes to zero. And it's not the way it works.
I mean, it's normal for somebody to say, hey, right now we're looking at unemployment at 10%. This is a terrible environment that we're in right now.
Yeah.
And they automatically equate that to, this is a terrible environment to invest.
Yeah.
And so it's normal for somebody to say, hey, I'm going to wait until, let's say the unemployment rate drops from say 10% down to 5%.
I'm going to wait till things feel better, right?
So we looked at this study, right? So we just did the math. It's not a study. We just did the math. And so if you were to, let's say you were an investor during the 2008, 2009 crisis, and let's say you had some money to invest, but you're sitting on the sidelines. And let's say you wanted to wait until the unemployment rate drops from 10% down to 5%.
And it was 10% end of 2009, right? October.
Right. So the market already bounced before the unemployment rate peaked during this environment.
So the market's bouncing, unemployment keeps going up.
So the market bounced. It bottomed out on March 9th, 2009. The unemployment rate didn't peak until October of 2009. So a few months later, so about 6 months later. So if you were to wait from October 2009 until the unemployment rate at least crossed below 5%, that would have taken 6 years. So here.
So it's 2016 is once that unemployment starts getting in that normal range again, right?
Yeah, it was January 2016. And so the S&P 500, your total return was over 120% during that time frame.
So if you're sitting out feeling like, hey, this is uncomfortable, unemployment's high, we're not in a good economy, I'm going to wait till things feel better. You lost out on 120%.
More than doubles your money.
From just sitting in an S&P 500 index fund.
Correct.
Yeah, that's life-changing. Like that is life-changing, unrecoverable.
It's one of the greatest bull markets we've had in history that you've missed out on.
Yeah, just because you're waiting for things to feel better. And I've asked this question when I've had the conversation with some friends of saying, hey, I want, when do I wait to invest, or what should I do? Or I want out of this market. And commonly I'll say, hey, all these things that you want, if so-and-so was better, if the unemployment rate was lower, if the economy was better, if savings rates were better, do you think the market would be higher than it is today or lower? And almost always the answer is, well, it'd probably be higher. It says, okay, so should you wait for all these things to be good? Because you're going to be buying in at a higher price.
Yeah.
And the data shows this is really clear every time this has been the case. So I think it's a huge takeaway for somebody with their current situation right now. This aligns where we are. People are worried about a recession next year. Yeah. The data shows it's probably going to happen.
It's going to happen.
And a lot of people are thinking, what do I do with my money? I'm going to wait for this to pass. There's going to be a recession. I don't want to invest.
And it's going to be ugly too, because typically whenever companies start to lay off individuals, it starts to happen very, very fast. So the unemployment rate starts to bounce higher very, very quickly. So it's not going to feel good at all. And so we're sort of in this limbo right now where we know something bad is about to happen. It's not going to feel good, but that doesn't necessarily mean that the stock market is going to crater or that this is a terrible investment or time to buy.
Yeah.
I mean, the S&P 500 could be higher 12 months from today. We don't know.
You do not know.
I mean, bottom line is it's really hard to time the market. It's really hard to pinpoint exactly where the unemployment rate's going to be. We don't know where the peak is or where the bottom is. Mm-hmm. But I think what we're trying to say here is stay invested, stay the course. And if you happen to have extra money just sitting on the sidelines, whenever the unemployment rate is high, that's an even better time to invest.
Absolutely. This is why I personally like to do an automated or systematic approach to investing, because I know I'm a human like everybody is, and things are emotional. So I personally, if I have money that's not for a short-term need, I'm going to invest it whenever it's available, and I'm going to get on with my life, because I don't want to spend my life going through the nuance every day of what's this news or that news. Should I wait? Should I not? Is it better or worse?
And the data shows you're probably going to be wrong.
And the data shows you're probably going to be wrong because everybody's wrong. So just if it's, again, it's just looking at, do you have a long-term goal? Do you have a short-term goal? What's the money for? Figure that out and then go, if I don't need this for the short term, if I'm an investor, I'm going to invest it. I'm going to get on with my life.
Keep it simple, stupid.
It's a good way to do it.
That's it.
It's a good philosophy right there.
Yeah. So if you have any questions or you have any comments, feel free to reach out to us. We're two nice guys. We like to reply to comments and emails. So you could go to thewealthfix.com for more information and to contact us. So we'll see you next time.
See ya. Thanks
for your time.